We live in times where attention spans are at times limited to YouTube shorts and Insta reels. Our exchanges, clearing corporations, and depositories, they have played a crucial and pioneering role in growing our capital markets ecosystem. In India, there is a concentration in terms of one exchange and one clearing corporation dominating the equities landscape. MIIs are not regular commercial entities.
On behalf of Business Standard, let me extend a very warm welcome to Mr. Ananth Narayan Gopalakrishnan, full-time member of the Markets Regulator, the Security and Exchange Board of India, on this second day of the Business Standard BFSI Insight Summit 2024. Mr. Narayan has over 2.5 decades of experience in the banking and financial markets, a period during which he has served as director on boards of banks like Deutsche, Citibank, Standard Chartered Bank, and several other corporate entities. At SEBI, Mr. Narayan handles several departments like market intermediaries, regulation supervision department, the alternative investment fund, foreign portfolio investors department, Department of Economic and Policy Analysis, integrated surveillance department, and the information technology department. At SEBI, he has played a key role in developing the new derivatives trading framework. Before assuming charge at SEBI in 2022, Mr. Narayan had held positions of Associate Professor at SP Jain Institute of Management and Research, Mumbai, for nearly 5 years. He also served as a member of various advisory committees constituted by SEBI and the Reserve Bank of India. Mr. Narayan has been an active member of the financial markets since 1993, when he completed his postgraduate diploma in management from the Indian Institute of Management, Lucknow. Earlier, he did his graduation in technology, it was electrical engineering, from Indian Institute of Technology, Bombay. Many thanks, Mr. Narayan, for agreeing to be with us here today. May I please request you to address this audience and thousands who are watching this summit proceedings online and deliver your keynote address on reflections on our market infrastructure institution ecosystem. Thank you very much. Over to you, Mr. Narayan. Thank you.
Good morning, everybody, and thank you so much, Shailesh, for those very kind words. And a special thanks to Business Standard. Your exciting sessions will come after mine. As a regulator, my job is to make sure put you to sleep right in the morning and be as boring as possible. But thank you, Business Standard, for once again giving me the opportunity to address your annual BFSI Summit. We live in times where attention spans are at times limited to YouTube shorts and Insta reels, and yet where opinions are vehement. Amidst all this, policy formulation calls for informed, calm, and constructive engagement. Media houses such as Business Standard and forums such as this summit have a crucial role to play in this regard. Today, I will offer some reflections on our market infrastructure institutions, or MIIs, namely our exchanges, clearing corporations, and depositories, as a prelude to seeking your considered feedback. This is not a this is a kind of an arcane topic. Normally, one doesn't talk about MIIs. They are the invisible structure which holds the entire capital markets ecosystem, but they're extremely important. MIIs are statutory institutions that have played an admirable role in the development of our capital markets. They're required to put public interest first, serving as first-line regulators and as a public utility, even as they operate as commercial organizations. I will first make the case that we must continue to strengthen their governance framework, ensure that they are staffed by high-quality risk, compliance, and technology personnel, and further strengthen institutional mechanisms to ensure that they can appropriately deliver on the core public interest mandate of the MII. I will also speak about the construct of our clearing corporations, or CCs. They are currently owned entirely by their parent exchange and depend on them for equity infusions, contributions to the settlement guarantee funds, and for resources. There is an argument to be made amongst CCs that operate in interoperable segments such as equities for them to be truly independent and standalone MIIs both in form and in substance. I will begin with a short background to our MIIs. Our MIIs provide the critical superstructure for our capital markets. Particularly over the last 3 decades, guided by policymakers and regulators, they have played a crucial and pioneering role in growing our capital markets ecosystem. MIIs are the first line of defense charged with ensuring investor protection and market integrity. Amongst other things, they are required to ensure adequate disclosures by issuers of securities, conduct appropriate surveillance to deliver a free and fair market bereft of unfair trading practices, manage risk and operations to deliver smooth clearing and settlements, monitor the conduct of brokers and other intermediaries, and ensure that market technology platforms and ledgers are fair, secure, reliable, and resilient. MIIs have a unique operating model in that they are empowered by law to regulate their own paying clients, such as unlisted corporates, trading members, clearing members, and depository participants. They are required to primarily focus on public interest and ensuring the integrity of capital markets. At the same time, they are also commercial entities, and the larger MIIs in equity markets currently enjoy high operating margins with profits before tax to income ratios of 60% or more, high equity price to earnings ratios, and significant dividend payout ratios. What is the framework that we have adopted to balance the public utility and commercial objectives of the MIIs? Given the primary need for an MII to serve public interest and act as a first-line regulator while staying commercially viable, different jurisdictions and regulators have adopted different operating models for different MIIs. In India, following much consultation and deliberation over many years, we have chosen a model that allows for competition amongst MIIs, allows them to make profits and pay dividends to their shareholders, and allows for public shareholding in and listing of MIIs, except for clearing corporations. There are advantages of this construct. Competition, public shareholding, and profits foster efficiency of MII operations, helps attract market talent to MIIs, and spurs and finances innovation. Competition also creates a natural backup and redundancy in the ecosystem, avoiding of the risk of having all our infrastructure eggs in one basket. Of course, in India, there is a concentration in terms of one exchange and one clearing corporation dominating the equities landscape. Public shareholding and listing can also help improve transparency and enforce better market accountability. There are possible downsides to the construct as well. MIIs are not regular commercial entities. Competition, public shareholding, and listing can create incentives that give primacy to commercial outcomes over the intended core and primary statutory role of the MII as a first-line regulator and public utility provider. There is a risk, an actual risk or a perceived risk, of a potential race to the bottom with compromise on risk or compliance or in their role as a first-line regulator of their members, particularly as MIIs compete for clients whom they must also regulate. There is the potential that investments into appropriate security, technology, risk, and operations are deprioritized over commercial outcomes. There is the potential that products or securities are launched and persisted with without adequate safeguards around investor protection, suitability and appropriateness, and with a view to maximizing MII throughput and revenues. To foster long-term confidence in the capital markets ecosystem and to ensure financial stability of our capital markets, not only must all this be avoided, they must also be seen to be avoided. There are mitigants in place to ensure that these downsides do not materialize. But given the serious implications of any failure, there is always room for review and improvement. The first and crucial mitigant is the governance framework of the MIIs. MIIs are required to have a governing board in which public interest directors, or PIDs as we call them, must comprise the majority. SEBI chooses and appoints PIDs from amongst the candidates suggested by the governing board of the MII. This is a crucial appointment calling on people of experience, competence, integrity, management and people skills, and stature. MII shareholders do not have a direct say in the appointment of such PIDs. Of course, shareholder and executive directors on the governing board of the MII are part of the process of suggesting suitable candidates to SEBI. In selecting PIDs from amongst the candidates suggested by the MII, SEBI tries to ensure that the governing board has appropriate and diverse skills and expertise, including in technology, markets, risk, compliance, management and administration, finance, and law. As a collective majority on the governing board, PIDs are charged with ensuring that the MII operates primarily with public interest in mind, focusing on its role as a first-line regulator and public utility rather than on commercial outcomes. In recent times, SEBI has tried to deepen and formalize the two-way engagement with the PIDs, both collectively and as individual MIIs, so that these objectives are better appreciated and affected. As an aside, we had sought public feedback on whether we should change the process of appointing PIDs to allow for direct shareholder involvement in their appointment. The overwhelming feedback from an expert working group, the Secondary Market Advisory Committee, PIDs and MIIs themselves, and the public at large was to continue with status quo. We will still explore ways to improve ease of doing business for our PIDs while making the process of their appointment more institutionalized and objective. However, PIDs do not run MIIs on a day-to-day basis. While the governing board sets the tone at the top, the culture of giving primacy to public interest must run deep amongst the management and the employees of the MII as well. Besides having a capable MD and CEO who's accountable for the entire MII, including its commercial outcomes, there is a need for able and accomplished heads of the primary MII verticals of technology and operations and of risk and compliance. These crucial verticals must be willing and empowered to operate independent of short-term commercial considerations to ensure that the MII delivers its primary mandate as a quality public utility and first-line regulator. SEBI has advised the governing boards of MIIs to upgrade the KMPs in charge of these key verticals over time as necessary. These are extremely crucial KMPs. We do not mind if the MII actually spends good money to hire the right people. SEBI will also require the Chief Technology Officer, the Chief Information Security Officer, Chief Risk Officer, and Chief Compliance Officers of MIIs to independently interact with the appropriate governing board committee, which would also directly contribute to their annual appraisals. Given the critical need to strengthen these verticals, we are also considering SEBI's own direct involvement in approving the appointment of these specific KMPs, just as we today approve the appointment of the MD and CEO of the MII. We believe that such mechanisms can further facilitate and institutionalize appropriate focus on the core public utility mandate of the MII. Finally, SEBI is tasked with regulating and supervising the first-line regulators, the MIIs. We have upgraded our supervision of MIIs significantly over the past few years and intend to further invest in enhancing and sharpening our tools and skills, particularly by building a specialized cadre of IT supervisors. SEBI's standard enforcement processes can sometimes follow a long and legalistic journey. Automatic financial disincentives are designed to avoid such delays when it comes to supervision of our MIIs. But that does come with the possibility of creating some perverse incentives. For our part, we are happy to consider specific changes that could foster honesty and help sharpen the focus on material rather than peripheral supervisory issues. From the next year, we will also institute independent external evaluation of MIIs once in every 3 years to supplement our own supervision. These are some of the thoughts that we have in terms of how do we strengthen the MII governance ecosystem so that they remain primarily focused as a public utility than worrying about their commercial outcomes. I will now turn specifically to our clearing corporations. Clearing corporations act as central counterparties for clearing and settlement. They play a crucial role as a first-line regulator managing several forms of market, counterparty, operational, and technology risk that accompanies trading and settlement in securities markets. They provide the comfort of novation and settlement finality backed by processes and ultimately by a strong default waterfall. Given the crucial role that they play, in many jurisdictions and markets that have multiple exchanges and trading platforms, such as the US, CCs operate as true public utilities that are owned by stakeholders for their collective good. In India as well, while exchanges and depositories are allowed to be listed, our regulations clearly state that CCs will not be allowed to list. However, there is an anomaly here, in that currently our clearing corporations or CCs are 100% owned by their parent exchange. When the parent exchange lists, therefore, their CCs are also de facto listed, in that the shareholders of the parent exchange consider the consolidated financials of both the exchange and the CC. In the past, this was implicitly accepted and tolerated, since the CC would only clear the trades of its own exchange. However, since 2018, we have introduced interoperability in the equities market settlement so that a CC can clear the trades of multiple equity exchanges rather than of the parent alone. This interoperability has improved the ease of trading and settlement for investors while allowing for better backup and redundancy in our securities ecosystem. It has also materially altered the implications of 100% ownership of a CC by a single exchange. As on date, the dominant equity clearing corporation, owned by the dominant exchange, clears over 85% of all cash and derivative equity market trades dealt on each of the large exchanges. In this context, 100% ownerships of CCs by a single exchange does raise questions of the potential for actual or perceived conflict of interest. The second anomalous feature of clearing corporations in India is that unlike many global and domestic peers, our CCs are dependent on their shareholder, i.e. the parent exchange, for equity infusion, for default fund management, and for other resources such as technology and people. In most jurisdictions, participating clearing members contribute to the settlement guarantee fund of the CC. In India, as on date, clearing members do not contribute to the settlement guarantee fund of the CC. Instead, the CC itself, the exchanges from where the trades originate, and the owner of the CC, i.e. the exchange that owns the CC, must constantly enhance the settlement guarantee fund on their own. There is a need to fundamentally review this construct of our clearing corporations. There is a case to consider making the clearing corporations truly independent and self-sufficient with broad-based ownership and with clearing members having a risk-based skin in the game. All this may be crucial to ensure that there is an actual and perceived level playing field across all MIIs. This may also be crucial to ensure that sufficient resources are readily and independently available to the CCs to invest in appropriate technology, risk management, and people for them to continue delivering on their mandate as a key public utility and a first-line regulator. If we agree on the principles here, the question of how to bring about this change in a manner that is fair, equitable, and non-disruptive for all stakeholders will then arise. We have debated this in our Secondary Market Advisory Committee, where some ideas have been proposed. In a sense, some form of demerger of the equity stock exchange and the equity clearing corporation may perhaps be a way out, though there are some legal and regulatory challenges to navigate. We will come out with a public consultation on all this shortly and seek your considered views in this regard. I will now end where I began, on emphasizing the need for informed, considered, calm, and constructive engagement on policy formulation. My attempt today has been to lay out the contours of our thinking on a possible way forward for our MI ecosystem, on how to ensure that they stay focused on public interests rather than commercial outcomes, and how the clearing corporation construct can be reimagined. We must ensure that our commercial regulators that are to focus on public interest are never seen to become regulatory duopolies focused on private returns. Bertrand Russell once said, "I would never die for my beliefs because I might be wrong." I agree with him. We would be very happy to modulate our own policy views through our consultation process based on the logic and the data presented to us. Once again, I really thank Business Standard for offering this platform for constructive engagement and deliberations. I wish you all the best for this particular summit. Thank you again.